Well, good evening and welcome to the Digital Finance Analytics live stream for Tuesday, the 19th of March, 2019. And welcome to this show. Thank you very much for spending time with me. And those of you who watch the pre-show will know that we've got quite a few on already. I'm sure there'll be others joining. Now, what I'm going to do is my normal thing, which is I'm just going to do a little bit of an introduction first, and then I'm going to take questions from the live stream. So hold your questions for now so that I can go through the first part of this, and then we'll move on from there. Just in case there's any doubt, it's Martin North from Digital Finance Analytics. I think I've probably said that enough, but just so people know. And let's now go to start the show formally. Okay, so the first thing I want to do is just spend a few moments going through a couple of quick things. As normal, the running order for today, this introduction, which won't take long, house rules, really important. About our models, those of you who've been following DFA will know about that, but it's important people understand that we're talking about data-driven analysis here, not just opinion. Some key slides just to set the context. Then the questions and answers. I've got a whole bunch of questions already preloaded from beforehand, but I'll also take questions live. And what I'm going to try and do is go with the live questions first, and perhaps then that will sort of coincide with some of the other questions, but if necessary, then we'll go to the written questions too. I also want to talk towards the end about my next Harry Dent event. One of the things that I get asked often is, so what should we do? How should we plan? What should we be thinking about? And, there are lots of different people you can talk to. I actually think Harry's quite interesting to talk to. I don't necessarily buy all his arguments, but I think he's going to be quite interesting. So we'll have him on in a little while, and not tonight, but in a week or so, and there'll be an opportunity to interact with him live, and I'll tell you more about that at the end of the show. So one reason to stay if that's of interest to you. And then we'll sign off. And this will probably take, I forgot to mute my phone as I always do. Sorry, let's do that now. This will take about an hour and a half, perhaps, plus or minus. We'll see how we go. Okay, so in terms of house rules, a few things. Firstly, please note, this is not financial advice. I'm not a financial advisor. I cannot give financial advice. I know a lot of people ask me for specific opinions and ideas. I really can't do that. I'm not allowed to. It will be illegal. I can talk in general terms about my research. I can talk in general terms about what I'm seeing, but I'm afraid that you've got to sort of take that information and then make of it what you will. So this is not financial advice. Please play nice in the chat room. No racial slurs. We've had a few on in the past. We will make people disappear if necessary. We don't like doing that, but this is actually actively moderated for that very reason. There are so many smart people and people who have got really important views and opinions to share. I don't want it to sort of get diluted into a racial slur, so let's try and avoid that, please. This is at the 19th of March 2019. If you're watching this 5 years later, you will know whether I was right or whether I was wrong in my calls. We'll see, and I might come and visit it 5 years into the future and see whether I was, in fact, correct or not. Please use Walk the World to get my attention. There is a load of stuff going on the chat. John Adams has just joined, I noticed. There's a load of, hello John, there's a load of chat going on. So if you want to get me to look at it, please use at Walk the World. It just helps to focus my attention. So now just quickly on the core model, I think you will know this if you've been following me. We do surveys of households. We collect information from all sorts of other sources. We put them into our core market model. That is really where our analysis starts, and then that feeds our mortgage industry work. It feeds the various reports we do for clients, and it feeds all the stuff that goes through to the blog as well. The point about this is we have 52,000 households in our survey at any one time, which means that we are getting news from the front line. And that's why I'm much more confident about my delivery and my deliberations than perhaps other people, because I'm seeing what real households are telling me. We cut it all sorts of different ways, from property status, geographic locators, different segmentation views. We can slice it and dice it, and we do that quite a lot. Now, the RBA minutes came out today, and a few things to note. The RBA is acknowledging that home prices are continuing to slide, for 13% lower in Sydney, 10% lower in Melbourne. Prices in Perth now declined to those levels in 2006. It's worth just reflecting on that. More than a decade, we're saying that prices are now back to where they were a decade back. So it's something which people need to understand. A fall in prices doesn't necessarily have to be a quick fall and a quick bounce back. it can be a long, slow grind, and you'll see more about that shortly. They talked about slowing dwelling investment. They talked about the fact that there is tighter access to credit. Actually, that's interesting because they don't often talk about access to credit. So tighter credit, we always say tighter credit is driving slowing home prices. They're acknowledging it in the context of new construction. And the point there, of course, is that there's probably enough supply already in stream for the next 12 to 18 months. So it's not like it's going to immediately end up with a shortage of property, in my view. There's so many more on the market. Retail sales volumes are down 0.1% in December. We think that households are really under the gun, as we've talked a few times. And interestingly, they're now recognising that the markets are predicting that policy rates will be lowered by early 2020. I think it's true to say that the Reserve Bank has gone negative on the next rate move, but they're being a bit coy. Now, the ABS produced their information today. This is their quarterly data to December 2018. And it's, again, showing price falls. Now, the point about this is it's delayed, but it is actually driven by real sales and real transfers, and therefore it's perhaps as robust as anything. It's just it's rather late. But this is the bottom line is important. Total dwellings fell by $133.1 billion. This is the third quarter where we've seen wealth destroyed overall in Australian households. And that wealth destruction, for me, is the critical thing that's driving a lot of the behaviour at the moment. Here's another way of looking at the same data. And you'll know that I've worked out how to do these, which is to draw charts that sort of come to life. So this is the Sydney trend from 2010 onwards, and you can see the dive down. This is the annual movements, effectively quarter by quarter. Melbourne sort of dropped later, but more dramatically perhaps, but has ended up not quite as low as Sydney. This is Brisbane, who never got the peak, but is dipping a little now. This is Adelaide, again moving down, not yet in negative territory, but looking as though it could get that way quite soon. Perth, of course, a little recovery, but now sliding back again, I'm afraid. And that recovery didn't get into positive territory. It's just that the rate of growth decline, actually, the rate of decline just slowed, but now is more significant again. And then we've got Hobart, who did very well, but is coming off. Darwin, who's just been languishing. They're 25% down from where they were 5 or 6 years ago and continuing. And even Canberra, still in positive territory, but coming down. So there's a lot of information here about prices falling. And you know that I think prices will go on falling. But another way of looking at this is transfers. And so the data from the ABS also tells you about the number of transactions recorded in the formal registries across the states and territories. And the here point is to make is that the most recent data is preliminary. It may be higher later, but you can see the trends are clear. The number of transactions happening in the market are significantly lower, and it's significantly lower in pretty much all states, but I've picked Melbourne because this is where some of the most significant drops are showing. And we can see here the number of transactions which are actually going through the system are consistently lower than they were. Next on housing credit, still growing at 4.4%, but it's lower than it was. The credit impulse, as we call it, is continuing to weaken. Investment lending is 1%. Owner-occupied lending is annual growth at 6.2%. Business credit isn't growing that much, and personal credit is coming off the bottom two. So we can see that there are pressures here on the credit momentum. I think credit is going to remain tight, despite some of the recent unnatural acts that ANZ, for example, did and others will do. I still think we're going to see tighter credit ahead. Household confidence, that's one of the measures that I run. So I look at it three ways. The free affluents, they're the people without mortgages but with property. Those who are renting, and those who are mortgaged, either investment or owner-occupier. And the point here is to see that the confidence levels are continuing to grind lower, and now the latest data shows that all household segments are below the neutral setting. And even the free affluent, they're the ones who tend to vote with a more conservative orientation are also now not very confident they're below the 100% level. So what that basically says is we have some significant issues with regards to household confidence in Australia. Mortgage stress is rising still. I report this regularly. 31.1% of households, more than 1 million, are now struggling with cash flows, with mortgages. And what the point about that is that number's continuing to rise. You can see that on the yellow line. Household debt's still very high, and there's nothing to change that. So incomes are flat, costs of living are rising, people are struggling with big mortgages, and many people, of course, had mortgages they should never have got in the first place because the lending standards were too tight. They're now struggling to eat that elephant, as it were, and my expectation is that mortgage stress will continue to rise. Bank funding is a bit of an interesting one because the BBSW has dropped. So we were up at 30 basis points a month or two ago, and that was terrible in terms of margins. Now they're down a bit, but that about 8.5 basis points from where they were just over a year ago. But that's still enough to cause problems, and the banks are still struggling with funding. That's reflecting now the lower rates in the US. The Fed, of course, has changed its tune in the last 6 weeks or so, and that's flowing through to very significant momentum in terms of funding. However, there is still another factor, and that is the question of trust. Do international investors trust our local banks? And some of them are saying, well, we're not sure anymore because there's a lot of stuff that we are not sure is as clear as it should be. So as well as the pure funding mechanism, there's a trust question too as well. The financial sector is down 7% over the last 12 months. You could see the run-up after the Hayne effect more recently, but it's not doing great. And I look at all the data that I see, margins are under pressure, momentum in the lending sector is definitely stalling, particularly mortgages. So it's tough to see how banks here in Australia are going to manage their portfolios going forward. Defaults still rising just a little bit. We did a blog post on that quite recently, and we think that there is going to be more of that later on. And just quickly, there's an article which came out today at just after 4 o'clock called Australia Could Be the First Domino to Fall in the Next GFC. This was actually a John Adams special, but I was also quoted, and Eddie Hobbs, who was the guy I interviewed from Ireland, is also included in this. It's worth reading the article because basically our thesis is maybe unlike the last few times where effectively things happened internationally and it flowed through to Australia and Australia got hit, maybe we're in the situation where we're going to be the trigger that actually creates broader issues around the world because our housing market is looking pretty sick and there are a whole bunch of other indicators. Retail is down, GDP is down, all those things. So it's worth reading that article. John and I are going to do a more detailed post where we dissect this, but I just thought I'd alert you as it came out today. And now just on the scenarios, so that our core model supports our scenarios, and the scenarios gives us a bit of a flavour of what's going on. It's a way effectively of trying to help people understand that it is not a simple task to predict what is going to happen. So I use weights on the scenarios. None of these scenarios may be right, but it tells you what my thinking is. So effectively we have business as usual, things going to get better, not yet doomsday, Armageddon, which is what I call Ireland 2.0, and doomsday, which is Iceland 2.0. And then we look at it across things like the RBA rate, unemployment rate, mortgage stress, bank losses, what home prices might do, whether the unnatural acts will continue and what they might be, and then there's a probability weighting. So the first one is, if you take the RBA base case, my prediction now is rates at 1% over the next 24 to 36 months, so they'll cut again. They'll ease credit further, but I only give it a 1% chance of actually coming true, which is extremely low. And my view has been for some time that the RBA is just not seeing what we're seeing in the data. The risks are a lot higher. And either they're doing it because they have a different perspective, or they are doing it because they want to try and talk the market up. The next scenario is things going to get better. Again, now I've put the rate down to 1%. The unemployment rate goes up to 5.8%. And I give that a probability of 10%. So that's down from 15% last month. And here, my expectation is that home prices in the major centres will go down 15 to 20%. The most in Sydney and Melbourne, slightly lower in some of the other states. But nevertheless, that's a significant drop. And of course, we haven't yet got there. So there's a 10% chance that we might get away with that. If we do, mortgage stress will be around 34% of households, and bank losses will be about 5 basis points, which is up from where they are today. The next one is not yet doomsday, and on this scenario, I now think rates could go down as low as 0.5%. I think the unemployment rate could well rise up to sort of something like 6.8, something like that. And the mortgage stress number will be up towards 36%. The bank losses will be up around 9 basis points, but home prices could well drop between 20 and 30%. And in that scenario, one bank will need a bailout. Now, I've put my rating up here now by up to 65%. I think this is the most probable scenario that I'm looking at now. And so, if you like, my weighted estimate of what I think is likely to happen is sort of cohering around the not yet doomsday scenario, which basically means that I have downgraded the Ireland 2.0 scenario. And the reason I've done that is because of the fact that all of the major banks around the world, the central banks, are now talking about doing quantitative easing. So they're looking to kick the can down the road. And if they're successful in doing that, then effectively we can get away potentially with a not yet doomsday scenario. If they're not successful, then we get an Armageddon scenario. So in that scenario, rates will come even lower towards zero bounds. We've seen mortgage stress of 39 to 45%. We see the unemployment rate rising. We see home prices down 30 to 45%, 45% in the major centres, 30% in some of the other centres. There will be bail-ins, there will be bailouts. There will be QE going on left, right and centre, and QE in Australia. And that's got a 21% rating. And then finally, doomsday. So this is effectively, if we don't bail out, if we don't do QE, if we let banks fail, and that's, of course, is what Iceland did, interest rates would go below zero, unemployment rate would be very, very high, mortgage stress would be astronomical as well, the bank losses would be huge, home prices could drop up to 80% in some places, and there would be QE and bank failures and all sorts of things. But I give that a relatively low rating over my 24 to 36 month period at the moment, simply because I think that essentially what we're going to see is a local problem rather than an international problem driving what's going to happen in Australia. So that's my favoured scenario at the moment with a 65% weighting. So 20 to 30% easily achieved with potential risk on the downside beyond that. Okay, so with that as an introduction, I'm now going to come back to the Q&A session, and I'm going to start looking at the questions from the live stream. So I'm going to go up to the top and see what people have been saying. Hopefully you can bear with me while I do that. So let's have a look. Okay, questions. What have we got? Okay. Somebody said, yeah, get in touch with Morgan Kelly. I've been trying to, actually. Hard to get hold of, but there's a few people I'm trying to get to have another perspective on some of these things. But there's quite a few people that people recommend. In some cases, I'm trying to track them down. In other cases, if they've been around a lot and have made lots of comments elsewhere, I try to find people that are perhaps a little, less used. Now, I'm Lost says, how will aged care bonds be affected by the drop in house prices? Yeah, that's a very good question. So there's a few things in that, right? So firstly, of course, there are arrangements where people can actually pull money out of their property and support themselves through later retirement, typically no more perhaps than half the value of the property. And one of the things about those reverse mortgages, as they're called, is that they effectively will not displace that individual or that household until they choose to move. But of course, as property prices fall, then the value of those bonds and the value of that security goes down. So therefore, there is less opportunity to use reverse mortgages through retirement to be able to actually generate sufficient income. So I think a lot of people in retirement and thinking about going to retirement need to be very cautious about what's going on at the moment. And interestingly, of course, quite a few people who had equity decided to give some of that down the generations via the bank of mum and dad to help their kids buy into the market. And suddenly they're finding that their own properties now are beginning to slide. And so their certainty about the value of their property into retirement is now very much in question. Okay, let's see what else we've got in terms of questions. John Adams has just put the link up to the news article that we mentioned a little moment. If you had to pin down, okay, this is Victor. If you had to be pinned down, I'm not sure about that, to give a specific 2-year range when the bottom of Sydney and Melbourne houses will hit, you're giving me 22, 23 or 20 to 21. No, Victor, my view is the bottom is going to be later. So I don't think we're going to see this as a short drop and then a significant bounce back. If you look at the trends of recent downturns across Australia, I did a post on this recently, we're already at the extended end of the last few downturns. There is nothing in my mind that stops the slides continuing. Credit continues to be tighter. Once we get below 20% drops, people will actually change their behavior, and then essentially some will panic and try and sell, some will be forced not to and will be stuck in their properties. I think that you probably should be thinking 4 to 5 years before we actually start to see any sort of correction. Perth, in my mind, is a very good analogy as to what we could be seeing across the country. So I'm afraid that your 20 to 21 or 21 to 22 is too optimistic. Okay, flipping down the list. Genevieve has put a link up. I've just released that to Genevieve. Thank you for that. Interesting. Okay. So Rod says, thanks to John Adams and myself for enlightening people with the truth. Well, you know, the truth is a perspective, right? So what we're doing is we're trying to give you an honest, objective opinion, but supported with the right and best analysis that we can do, but without any agenda. So we are not associated with a bank, for example, who, if property values fall, that bank suffers. We're not in that scenario. You know, so we're more objective and independent, I think. And the DFA is trying to provide all of you with information to be able to make better informed decisions. That's my primary objective. And I know that people want me to go further and say, tell me what to do, or make recommendations. Well, I can't really do that. I'm not a financial planner. And also, I think it's important that you know, you have the information and essentially then start to build your own strategies. And perhaps we can help by providing input, but we can't tell anybody, and we shouldn't be telling anybody, in my view, what to do. You keep stating that credit is the real problem. This is from Chris O'Tube. Even if credit was not restricted but immigration was stopped, do you think prices would have risen then? Yeah, I have in my model, I do model migration, because migration is one factor, of course, in the mix. But here's the thing. If you look at the census that was done 2 or 3 years ago, there was 1 million vacant properties across Australia, 1 million. And if you look at the census data, it tells you that the average number of people per property has not changed in 20 years. So I am very skeptical of this idea that it's all about lack of supply and it's migration that did it, right? I'm afraid that all of my modelling suggests that while migration in some postcodes have had an impact, and of course foreign buyers have had an impact, credit is by far the biggest lever. In fact, there is a post that I did some time ago to show you the relative sensitivity of credit versus migration versus other things, and I'll put a link in the comments so that you can go see that again. But frankly, migration is a furphy. I think that we're going to find migration will be slowed. I think the Conservative side of politics has already indicated that's the case. And it's an easy target in a way, but of course the truth is it's credit that has done it. And we've had 10 years of lax lending. The last 6 years in particular have been absolutely disgraceful, with banks making lending they should never have made. There were fraudulent applications. There were very loose lending standards. Loan-to-income ratios of 12, 13, 14 and 15 times, unspeakable. And frankly, that's the problem. So we've got to unwind all of that. And I'm afraid that migration, while it's important and while it's one factor, as Joe Wilkes and I discussed today, it is not the main problem. Okay. Just seeing who else has asked me a question. Will gold go up or down in crisis? I know that John says up. What are your thoughts? This is from Moet. Okay. John and I don't agree necessarily on everything, and gold is probably one of those things where, to my mind, the problem with the price of gold, it's highly manipulated. We know that some countries are accumulating gold dramatically. We know that some of the big investment banks are accumulating gold. But the price has been being manipulated, and of course it also is translated into the Australian equivalent because the exchange rate is also moving. So it's very hard to know the way that gold will play out. There are stories around that the change to Basel III may change the price of gold. Skeptical of that, I'm afraid. It may be that eventually the US ceases to become the currency of last resort, and people look for other ones, and gold could be part of that. But at the moment, it's too soon to say. And my own view is there is not enough evidence one way or the other to determine where gold prices will end up. The problem with gold is you've got to store it, or you've got to hold it yourself. And you can't buy food with gold. You've got to be able to translate it and convert it. And that, to my mind, creates huge risk. So all of those out there that are gold bugs and say gold is the answer, it is an answer, but I'm not convinced necessarily it is the answer. And I guess there's also the question of, well, what are you trying to do? Are you trying to preserve value, or are you trying to effectively speculate and accumulate? Maybe gold is a way of preserving some value, although, as I said, it's unclear as to what the value will be. But in terms of speculation, it's very hard to tell. And I've touched on Basel III. I'm not going to go into that in more detail. We may do a more detailed post on that, because some of the claims that Basel III is forcing banks to hold gold is not the full story. Okay, Genevieve's asked, what is your opinion on Canada and Californian house price bubble popping? Well, there are signs, of course, that prices are falling in some of those places. And it's interesting that in Canada, the foreign buyer momentum has really has disappeared, particularly Chinese buying. So if you look at some of the major centres there's been some falls. It's not uniform, though. So if you look carefully, you'll see in some of the indices they are going sideways, some of them up, some down. But I think the overall trend is quite clear. And if you look at the big international ratios in terms of debt to income and those sorts of things, Canada's up there. Not as bad as Australia, perhaps, but I think that the story is down. In terms of California, it looks to me as though there's significant negative news there already, and I'm expecting more. Okay. Yeah, Peter's mentioned Chris Kent's address today at Kanga News. He actually discussed bonds and all sorts of things, and I have read that speech. And as Peter says, he was asked, why is the 3-year bond rate below the RBA's cash rate? His response was, that is due to external pressures around the rest of the world. Yeah, I'm afraid that I disagree with that. I think there are some fundamental reasons why, in fact, that's the case. And it goes back to confidence. It goes back to a lot of the international hedge funds and other people that I speak with are worried about Australia, and they believe that there are considerable risk issues in the economy here. And so some of those issues with regard to where bond rates are to do with the higher level of risk. And it goes like this. If you think risk is higher, then effectively you're going to seek higher levels of returns. It's sort of part of the equation. I don't think the RBA really is clear on why it is that we've got this disequilibrium between the international markets and the local markets. And it goes back to their central thesis that everything is fine here. Employment is extremely good. We've got very little unemployment. The growth rate will be fantastic, etc., except I just can't see it myself. I'm afraid that they're going to have to forecast down their GDP number, I think, going forward. Okay. What else have we got? Do you believe Okay, so Craig's asking, what's the lead time from when the banks loosen lending standards again and price rises? Well, of course, the question is, how much will they loosen? If they do loosen, remember that they are under legal obligations in terms of responsible lending, and those responsible lending obligations were clarified by APRA very recently. So the Royal Commission revealed that many people were breaking the rules. So now there's a much tighter focus on responsible lending, which basically says when you make a loan, you have to be clear that it's suitable for the individual or household and that it can be afforded. That's a big change. I don't think that'll change going forward. There'll be some minor tweaks like the ANZ thing, which I think was a bit dumb, frankly, moving to an interest-only loan of 10 years is a problem. But even there, they still have to be clear that the party who's getting the loan knows how they're going to repay the capital. They still have to make an assessment based on 80% of the rental stream rather than 100%. They have to take account of their other commitments, and they have to be able to deal with a whole bunch of other issues they never did before. So to my mind, loosening is at the margin. In terms of its impact, given where we are, and given the fact that investors are basically saying, why would I buy when prices are falling? And first-time buyers are saying, why would I buy when prices are going to go further down? There isn't a huge appetite from people at the moment. There are people refinancing, and that will continue. And I suspect we'd see a slight uptick in refinancing, but that's just cycling the current loans again, creating churn and creating a bit of activity in the banking system and the banks. But new loans is the thing to look at. And my research from the surveys that I published a couple of weeks ago showed there is little appetite at the moment. So I don't think that even if they loosen credit, it would have a significant impact. Unless they went back to their illegal activities pre-Royal Commission. But frankly, who's going to be the one to say, yep, go break the law again? Okay. And Andrew asks, which bank will need a bailout? I'm not going to tell you which bank. That's not fair on them. What I would say is that you can assume that it's some of the banks with the biggest exposure to mortgages, and you might also want to think about which ones have the biggest exposure to investment mortgages, because we know from research done by the Bank of England that investment mortgages are 4 times as likely to go wrong in a downturn relative to owner-occupied loans. The reason is that investors will walk away much earlier because they've got nothing to lose other than their investment, whereas owner-occupiers have a home they want to live in. So, go do some research. Okay. This Sean is asking, how much emphasis do you give to the withdrawal of Chinese money on your house price falls? I do think it's been an important factor, particularly in some locations. So I look at Brisbane, I look at Sydney, I look at Melbourne, I look at Perth. In all those areas, there were pockets where a lot of the high-rise developments that were being bought by Chinese money. They were actually being built by Chinese builders quite often. And so there was this sort of international cycle where effectively funding came from overseas. The buildings were actually built by Chinese builders and they were sold back to the Chinese. And that was creating a whole lot of momentum in the local economy because, of course, a lot of the time they bought some materials locally. They also bought some materials internationally. Sidebar, quality of those materials are in question in my mind. So there's no doubt that it was an impact. But, of course, that's dropped very dramatically. The most recent NAB data showed that it was significantly down now. And, of course, China's tightened the controls on money coming out of the country. And they're actually trying to pull money back into the country because they've got their own issues. So, to my mind, this is going to be a long-term change in the weather with regard to the way that home prices run. Okay. Buden Gellard, what about the interaction between migration and credit growth, especially Australia's skilled migration? Skilled migrants being of correct age and skills are more likely to push up credit. Yeah, so what's interesting, you're right, some people who come in, particularly skilled migrants, with money to buy a property, but a lot of people who come in, even in those migration programs, don't buy immediately. They actually rent for a period of time first. And also what's interesting is that some of those people, if the economy goes the other way, may change their tune and decide to leave again. In fact, if you look at what's happened in some other countries around the world, in a downturn, a lot of the migrants leave as well. So it's certainly not as a single straightforward answer as perhaps you might think. Okay, Gareth says, 50, yes, 50% below the purchase price. Your thoughts? Yeah, well, okay, I've done some modelling on that, funnily enough. Yeah, so here's the thing, right? If you look at the high-rise apartments that were being built and sold in Sydney and Melbourne in particular, okay, there were three things going on. The prices were astronomical to start with, particularly off the plan, because they were being high-spec'd. They were effectively targeting investors, and they were basically there 18 months ago at the top of the market. Secondly, at the time, people didn't know about the poor quality of construction. I mean flammable cladding, and I mean things like Opal Tower. And thirdly, banks have stopped lending to builders who are actually wanting to essentially make those things finished. So we've got the situation now where, on average, prices are already down 20 to 25% if you look at the asking price compared with the off-the-plan price. But some are considerably lower. And in fact, somebody was telling me the other day that somebody at Opal Tower had actually dropped their price by 50% to try and shift it and hadn't been successful. So I'm afraid that we are going to see considerable falls, particularly in the high-rise investment markets. And the problem we've got is we do not know whether the sorts of construction issues that we saw with Opal Tower are replicated many times or a few times in other places. We do know that there are other issues in a number of other towers in Melbourne, Brisbane and Sydney. And we do know that we've got flammable cladding issues as well. So that's one of the reasons why I think that they will slow. The other reason is demand. Investors are just not interested at the moment. And frankly, even if they bought at half the price, the rental streams are also dropping at the moment, particularly in Sydney. So it's very hard to make a case for an investment property working unless you believe there's going to be capital growth. And as I said earlier on, my belief is there's going to be very little capital growth for the next few years. So the whole proposition, I think, is bust. Okay, I'm just going down the list, see what else I've got. Okay, so what I'm going to do now is I'm just going to flip over to the questions that I had beforehand. I'll come back and look up again some of the other ones a bit later. But I do have some questions here that I can also cover, and thank you very much for those who sent them through. So this is from Bradley. If China continues to add debt to maintain its economic miracle, sufficient to sustain... Let me do this. Can we do that? Yeah, there you go. Sufficient to sustain Australia in the short term or medium term. Now, that's interesting. So China, of course, is doing a lot of stimulation and a lot of activity to try and drive momentum in its economy. It's trying to get consumption up, but it's built a lot of houses, and the question is, will it build more houses and apartments, high-rises, more infrastructure investment? The question is, will that create demand for the stuff that we create here in Australia? Possibly, to an extent, but then you've got to also say that there have been examples where China's has started to blacklist, like some steel, for example, from Australia. So it may well be that we don't get the benefit that some people are saying. So I think that whilst China will continue to try and stoke its economy and will try and develop some momentum which would perhaps give us some benefit, overall, I think it will be a lot lower. Of course, there are other economies like India, where, of course, there might be some transactions that we can pursue as well. But I don't think we're going to see the same as we did in 2007, 8, 9, 10, where effectively we got out of jail thanks to China. I just don't see I don't think we're going to see a huge cycle up. That's my view. Okay, let's go to the next one. This is from Olivia. She says, I think she, maybe. Enjoyed your blog video, great. What's the right direction for getting real estate data from the mid-north coast of New South Wales, like Port Macquarie? Good question. Yeah, it's quite tough to get really good information. CoreLogic's data is probably the best that's out there, but it is got its limitations, and I've discussed that in the past. You can also go to realestate.com.au, and if you put in a particular postcode, you can, if you go down the bottom of the page, you can get a profile of that particular postcode and some trends and history, both in terms of units and in terms of houses. So I quite often use that. If you want to come up a level and look at multiple locations, sort of regions and clusters of postcodes, it's very difficult unless you actually subscribe to some of the core logic data, for example, and that can be quite expensive. So there is no simple way of doing it. The real estate sector will tend to use either core logic or REIA or realestate.com.au, I think. The point I want to make here is a lot of the information that is distilled and presented originates from the real estate sector themselves, like auction clearance rates. They then present that information without much validation and checking. And of course, they're completely objective and independent when they actually make those submissions. The fact that they tend to report successful sales rather than unsuccessful ones, and the fact that quite often now they're not disclosing the sale price, whereas previously they would, we'll just have to take that. So it is tough, it's difficult. There isn't a simple answer, unfortunately, in terms of the information sets that we need. Harry asked, given the tools on the RBA's table, can you please explain what negative interest rates actually are? Oh dear. Long story, short answer. Okay, so here's the thing. The idea is that if interest rates go below zero, so in other words, you have to pay to hold money at the bank or at the central bank, that will encourage companies to effectively use that money. Now, if you look at what's happened to zero interest rates around the world, like in Japan and in the Eurozone, it doesn't mean that end consumers necessarily end up getting nothing, but they get an interest rate that's like 0.01% or something, so it's almost nothing, right? But it's really designed for the international dimension and for the major players to force them to give those assets that they're holding and effectively invest them. Because what happens in the moment, we find as QE and zero bounds happens, is effectively people invest less. Why would you? When in fact there's very little return for those investments. So that's what it's about. And we did a post the other day, John Adams and I, on this. And the fact is that quantitative easing, negative interest rates, and all of that stuff is likely to ultimately come our way, unfortunately, particularly if we do get a global crisis coming in over the top of a local crisis. But essentially, it just devalues money. Anybody who's a saver effectively earns nothing, or worse. And what that basically says is you may have accumulated enough to try and get you through into retirement, but as I said the other day, you ultimately end up, rather than actually getting a return on your capital, you actually have to burn your capital just to survive. And if you look at people in the UK, for example, where interest rates have been very low for a long period of time, that's precisely what's happened. And there, they didn't go into negative interest rates, they just went to very low interest rates. So the other question is, how far down can rates go? And there are people looking at this at the moment. And there was a paper published quite recently saying 0.5 is fine, you can probably do that and not break the banking system. Take it further than that, and you can also break the banking system, because it basically changes the cost equation and margin equation at the banks as well. So this is very uncertain and uncomfortable territory, and I personally think that it's something that should be avoided at all costs. Okay, just another one from the file. Grant says, with the 2019 property forecasting looking dimmer and dimmer, are there investment areas you feel have a positive note or less exposed profile short of a term deposit? It's really tough. As I've explained to you, I don't actually believe that that gold or silver is necessarily a good safe bet. I think that some bonds at the moment maybe are not so bad, but there are risks attached to them, as I discussed earlier on. Clearly, some people are still saying, well, I'm going to hold property because ultimately, property is always going to be there. I think the question you've got to ask yourself is, are you trying to secure value and protect what you've got? Or are you trying to actually speculate and accumulate in this environment? Because your strategy will be quite different based on whether you're doing one or the other. But there is no simple answer. There is no silver bullet. There's no way out that I can simply say, do this or do that to take the risk off the table. And remember, of course, that deposits potentially have the risk of bail-in. Anne says, how will the retirement of the baby boomers over the next few years affect the Australian economy, house prices and interest rates? Yeah, so a lot of people are trying to sell. So, I did a down trading post the other day that said there are a lot of people who are now really worried about prices falling, and they actually really want to actually do some selling So in some cases, they're now selling and prepared to take a fall from what they expected because they need to crystallize that capital to be able to support them into retirement. A lot of baby boomers are doing that. And if you look at the relative distribution of those willing to buy and willing to sell, there are more at the top of the age groups, the baby boomers now looking to sell. This is big bulge, right? There are a smaller number of people down the chain, as it were, who can afford to buy. A lot of people are buying properties later and just don't have the incomes to be able to buy the big properties. So we've got this massive disequilibrium between the two. And I think that that's the first issue. The second issue is that retirement incomes from superannuation, from savings, are going to be depressed because the rates will be very low. And that means that many people who move into retirement will struggle to maintain the lifestyle that they thought they were going to be able to have. And the third point is the cost of healthcare will be going astronomically through the roof. It's already going up. It will continue. And that's going to put ever more pressure. So, frankly, baby boomers, who's had it to good, I think, up to this point, I'm a baby boomer, I admit it, I think the uncertainty ahead is looking pretty significant. Cameron said, two questions for the first one. If you have savings, which is the safest Australian bank to put your money in, not going to answer that. What I would say is it's very tough to know because there isn't the same disclosures in New Zealand. In New Zealand, there's a scorecard for each bank. You can go and look at each bank and you can make a relatively sensible decision. In Australia, none of that exists. Very tough to know. Sorry, can't tell you because it's undisclosed. What I'll be looking at is mortgage exposure, derivatives exposure, the capital ratios that they hold and their future strategy. But even that's all very fluid and it's hardly disclosed at all. APRA gives no information about individual banks other than just a little bit of high-level information about mortgages and other things. There is no single source. You have to look at the accounts for each of the individual banks, but of course they can dress the accounts any way they want within accounting standards, so it's very tough to know. What happens to the profits from the mining boom? Why is Australia in such bad shape? Simple. Costello and Howard did the wrong thing. So they had this massive flow of income. And of course, the mining boom went on a bit later as well. But instead of putting that aside, instead of building a fund and basically putting it into the future, I know there's a future fund, but that's to do with funding public sector pensions. It's not to do with a strategic asset for Australia. If you compare Norway, they built a massive fund off the oil boom and effectively have now got $1 trillion, I think, sitting in that fund ready to support the economy through the life cycle. The problem is that what we did was, in the easy times, we gave the money back by way of tax cuts. We made all the simple decisions. We just went on the same old merry way, which was resources, dig out the ground, sell it cheap, massive construction boom, massive finance sector boom, but no long-term strategic thinking about the future of Australia. No leveraging of those assets to be able to actually create future security for us. And now we're in the situation where we've got, the budget may just cross over into positive territory on a flow basis, as the budget within a month, but the underlying debt is huge. And the point is we haven't got a growth strategy for Australia. So I'm afraid that we blew it. Now, Daniel asked, what would force the major banks to revalue the residential property portfolios of their loan books? Great question. So here's the thing. We know that banks at the moment are using the valuations that were actually recorded at the date when the loan was written in all their calculations. They do some scenario analysis, evidently, but it's pretty limited. And they have no legal obligation to reset those valuations to a new level. Basically, unless there is, quote, a material change, but nobody's clear about what a material change is. One of the reasons why the bank economists are actually still not calling very deep falls is because it means that they're not saying there's a material change in their asset values. But there is a point at which that can't go on forever. And I've always argued that 20% drop is probably a reasonable bet as to when some of this comes home to roost. And if APRA started pressing the banks to revalue those assets, in some cases, we know that with negative equity that exists today at the moment, some of those loans would look very sick. What would happen then is that they would need to hold more capital against those loans. It doesn't mean they'd actually fundamentally go into default or anything, but it means that the capital costs of holding those loans will go up significantly, especially for the IRB, the advanced banks. And so the banks are very reticent to reprice their existing loan books. And at the moment, the BAL and the local APRA regulations are very vague on as to when you should do it and why you should do it. Okay, I'm just going back to have a look at the live stream for a second. See what else we've got. Okay, Vincent asks, there have been much discussion with Australian housing downturn scenarios with Ireland. Can you see any differences between our current downturn versus Ireland's? Yeah, there are some differences, and we did a post on this quite recently. The main one is we've got a flexible currency, so we can actually drive the dollar down a lot. And of course, what that will do is it will actually make our exports perhaps a little more attractive, but it will price imports higher. So we will import inflation, and that tends to mean that you'll end up needing to lift interest rates, perhaps, or ultimately go the other way when effectively we end up with a depression and stagflation and everything else and take rates very low. So it is a very, very uncomfortable scenario, but it's one that we have. The other one is that if you look at the spread of assets, Ireland had less resources than we have. We've been saved by the resource sector more than once over the life of Australia, and it's still huge for us. So even today, the iron ore price is very high, and that's helping to support the dollar. That's why it's sitting at around 71 cents at the moment. It's to do with very high iron ore prices and the fact that's coming back to Australia. So the fact of the matter is, we are different from Ireland in some ways, but then look at household debt, look at the exposures that we have, look at the construction sector, look at the comments from the public, both effectively the Reserve Bank and APRA and all the other players. All of those things are very similar. So there are some remarkable similarities to Ireland, but there are some differences. And we've not said we'll necessarily follow Ireland, but I'm afraid that a lot of the similarities, to my mind, outweigh some of those differences. And I do believe, and I've spoken to Eddie Hobbs about this, that there are very, very many similarities. And so therefore the Ireland scenario is certainly not off the agenda. Okay, just going down the stream once again, see whether there's anything else. Okay. Okay. Oops. Okay, Vincent says, thank you. You're welcome. Let's go back to the questions that I've got here. Okay. Okay. Tanya said, I was hoping for your life, you might be able to talk about the impending recession and economic change when about the rental market. Yeah. It's a very interesting question. So we know now that rentals in some areas of Sydney are down 3 to 5%. And that's because simply there's more supply of property, there's less ability of renters to pay, and that's because renters are fundamentally going to be able to pay based on levels of income, not house prices. So we need to understand that rents are associated with income, not house prices. Second is that there are more property investors at the moment doing the math as to whether they can make any money at all on the rental they've got at the moment. And with prices effectively coming off, that means there's no capital gain, so check that out. Then the question is, what's the relative cost of the loan versus the rental stream that I can get from the rental? And the fact is, in many cases, more than half of investors are now underwater, particularly in Melbourne, and Sydney's not looking that good. Queensland's much better. Hobart's fantastic. In many of those big centres, though, we've got households with multiple investment properties, often with interest-only loans, who are now switching to principal interest, so their costs go up, and they're now struggling to work out how to actually make this work economically. And so what it transpires, in my mind, is that we're going to see some property investors walk away, sell the property. Now, the question is, will they be scooped up by other people, or will we have higher vacancies and just higher properties for sale? Well, at the moment, we're seeing the number of properties on listings for sale rising very significantly. We're seeing the number of sales themselves falling, and we're seeing the number of property investors saying, I'm going to invest in property further, going through the floor. So there is a scenario that says you could end up with less rental property being available. But the other side of it is that people who might have rented, if prices continue to fall, can perhaps now buy. And in fact, many people are saying, well, in a year or two, it will actually be quite a good time to buy because price will be a lot lower. Now, I'm thinking, well, maybe 2, maybe 3, maybe 4 years. because actually quite often it makes sense to wait until prices have dropped significantly further. But essentially it could mean that there's a change of the equation between renting and buying. And the third point, of course, is that if Labour gets in, they're going to remove potentially negative gearing from new construction, from new existing properties, but keep it for newly constructed properties. So that will change the mix a little bit. My own view is that's going to have a marginal impact because many of the property investors are not really buying at the moment. So it's a complex situation. It will vary also by location. I think that in high demand areas, there will still be high rents, but in many other areas, and particularly in perhaps where there's a longer commute, rents will drop significantly further, simply because people cannot afford to pay high rents. And there are about 31% of mortgages in mortgage stress, but there's 46% of people renting in rental stress. So this is a huge deal even today, particularly in our major centres. Okay, now another one I've got. Cameron said, I've got a question. If you're running out of time, do it some other time. Well, we'll try and cover it now. The RBA has come out and said that they support the economy over the currency, therefore they'll probably drop interest rates, so the dollar goes down, yeah. So imports may be more expensive, exports will be cheaper, which means cars and TVs will go up, and I guess grain, beef and mining exports will be more attractive to buyers. So will they drop the interest rates and hope that mining will save us again? I think I've sort of discussed this, but just to repeat it, the thinking is that by lowering the exchange rate, you effectively make our exports more competitive, and if we are selling a lot of stuff and digging it out of the ground, we can churn that and get greater volume if there's demand. So is there going to be demand? Well, it goes to what China is going to do, as we discussed earlier on, or India or other places. There is clearly demand for some of the stuff that we actually do ship out, but then of course there are also questions about long-term demand for coal. There's a question of iron and China and other things. So it's not necessarily as clear-cut as perhaps it once was. I'd also make the point that I don't think this level of stimulus that someone like China can do this time around is going to be as big as it was in 2008, 9, 10. So I don't expect that will be sufficient to save us. Okay. And then Cameron also said, you said that lower dollar, less overseas money will come to Australia, and that could tighten up on liquidity. So what happens then? Okay, yeah, so the question about liquidity is important. So banks get about 20 to 25% of their funding that they need to manage their books from overseas sources. Varies by bank, some higher, some lower. Some of that's on short term, 90 days, some of it's on longer term, bonds and those sorts of things. But they are reliant on the international capital markets to bring that funds in. Now, let's be clear, banks create loans when they need to. They don't need to have the money sitting in the bank before they make a loan. They don't need a deposit before they lend it. Banks create credit, but they still need the credit balanced in their accounts, so they actually still need that funding to come in ultimately. And that's where the international funding comes in. Now, what will happen is that if liquidity dries up, if in fact you cannot get the funding to roll over, then the banks can do a couple of things. They can stop lending. And so the first thing you often see is that the banks just don't lend anymore or only lend for very, very low risk. Secondly, they put the price up for end borrowers because they need to increase the margin to be able to try and offset this. And thirdly, they may look for alternative sources, and that could, for example, look for mergers or acquisitions or other restructuring to try and deal with it. But ultimately, if international liquidity stops, our banking system stops. And we were very lucky in 2007 and 2008, around the time of the GFC, because we got a very big help from the Fed, who actually gave money into the Australian banking system to keep it afloat. We would have had a very different experience around the GFC had we not had that. And the interesting question, of course, is without that help, I don't think we'll get it this time if we have the same story, how will our banks cope? And the stress tests that we've seen being done by APRA are essentially done bank by bank by bank, but nobody's actually thought about what happens at a system level if all the banks have the same liquidity issue and effectively just tighten and tighten and tighten. So effectively, credit becomes less available, funding effectively dries up, the banks get into more difficulty, and of course, probably at that time, we've also got loans starting to default as well because unemployment will be rising. So all of these things come together. This is a very, nightmarish scenario we're talking about. Okay, here's another one. Comprehensive credit reporting. This is from Munesh. Yeah, so the status is that the major banks are now implementing it and they're having to share data. The smaller banks have another few months before they've got to do it. So what they're doing is they're sharing information about existing customers. Up until quite recently, that was very much held within individual banks, and while it wasn't very disclosed very much, there was information when people effectively defaulted. That was in the public domain, but the rest of it wasn't. Now, you've got effectively a whole bunch of additional information, plus they're also now starting to harvest information from people like mobile phone providers and electricity bill providers, so building a much richer picture about individuals. And that information is already starting to be used. NAB is already using it, for example, on mortgage applications to make a better assessment of the credit risk of individuals. And what that means is that some will actually find it easy to get credit. Some will find it a lot harder to get credit, because my surveys show me that in some cases, people have not been totally truthful with the amount of loans and other exposures that they've got. And the negative credit that was there previously never picked this up. Now there's a greater chance. So the chances are there will be people who will be unable to get credit. There's a greater probability that fraud will be picked up. And there's also a greater probability that some people will actually find that their loans get cheaper because they're actually a better credit risk. So it's not all bad, but what I say is people haven't realised the implications of this switch to positive credit. It's important that you check your credit record regularly now, because if something goes on it that is wrong, it could adversely impact your credit score, and therefore when you come to do something, for example, renew your insurance or get a new loan or get a new phone plan, it could impact your ability to get it. So it becomes very, very important. And it's not necessarily a win-win for consumers. It's a win-win for the banks, potentially. It's a win-win for the government. But there are downsides for consumers, I think. Okay, I'm just coming back to the live chat. I saw a few things going on there. I'm just going to have a read of those. Will you soon be discussing the mortgage debt accelerator in your videos, as Phil Seuss and Steve Keen did? Yeah, possibly, Victor. In fact, there's a chance, I'm not sure, but there's a chance that I may have a conversation with some of those guys soon. So more about that later. Okay, Joseph Wilkes said, top end in central Auckland is under pressure. March the 13th. Shortland Street auction of 35 properties, most of them unmarked locations, only 6 sales. Yeah, interesting. I think New Zealand is following us, Joe. We did a post on that today, right? It's very, very, very worrying, I think, what's happening over in New Zealand. You know, sympathy to them over what's happened over the last few days. But the property sector looks to me as though it's beginning to wobble, a bit behind. But the claim that New Zealand is unique, I think, is a bit misplaced. And Genevieve has also talked about Steve Keen. Yeah, we're trying. We'll see what we can do. I can't promise, but it's on my list. Okay. Interesting, Joe Wilkes says, New Zealand was also saved by the Fed. I didn't know that. Well, we should talk about that. That would be a very interesting thing to cover, I think. The Fed really has, you know, they were collaborating globally a decade ago. But with Trump at the helm, if there was a crisis, international crisis, the question is, would you find the same thing again, or would the Fed they just dial in and look after their own end of things? Okay, here we go. What are your thoughts on MMT? Do you see Australia running larger deficits to maintain the economy in the wake of the property correction? That's from JAIVXL. I'm not sure how to pronounce that. The short answer is MMT is one of those things that, although it's called monetary theory, has been around for quite a long time. But basically what it says is, look, don't worry about creating debt, worry about employment, worry about effectively keeping the economy going, and it will sort itself out. So the question is, what's the most important objective? Is keeping debt under control and being able to manage it, or do you not worry too much about debt and, you know, keep the economy going, keep people in work, give them jobs, whatever, is sort of the line of argument. And of course, it's being talked about here in Australia. It's being talked about in the US. And my own view is that MMT will definitely have more legs ahead. It will definitely be something which people will turn to when the other methods to try and manage the economy with, you know, the quantitative easing and the Keynesian view and everything else has really failed. So some people will grasp at this. My worry is that the full implications of MMT are quite concerning. And potentially, if you basically say, well, I can go on borrowing and borrowing because that's not the most critical thing to worry about, because government can always borrow. I'm afraid that I have to come back to, yeah, but debt ultimately costs. And if interest rates start to go up, huge debts can really kill an economy. So it's certainly an issue. Other thing I say finally is I'm hoping to get an MMT expert to come on the channel so we can discuss it further. John Adams and I discussed this last year. I think there's a lot more to be said on MMT, and you know, I'm not going to dismiss it out of hand, but there are some pros and there are some cons. Okay, Anne-Marie Connell says, if the Aussie dollar was to be sacrificed, how low could it go possibly? Well, people have been talking about 60 cents, 50 cents, you know. It could go that low. Some people are actually saying it would be a good thing, but I've explained, I think, why I think there are some questions and marks around that. Nobody quite knows. Flexible dollar means it can move quite dramatically and it could swing quite a lot. But the 71 cent, which is where it's been for the last few months, is supported by the iron ore price fundamentally, in my view. And there is significant pressure to the downside ahead, in my view. Okay. This is from Genevieve. When will the banks adjust their books in line with property price slumps? Or, okay, I think I've sort of given a bit of information that they won't until they're forced to. There's no reason they're being forced to at the moment, because most of the bank economists are saying, oh, minor fall, it'll recover very quickly, no problem. At the point where it looks like this is a structural readjustment, they would be forced to do it. Then the question is, how do they account for it? Do they effectively do it in pieces or do it one-off? It impacts capital, of course, immediately. It impacts their balance sheet significantly. And I wouldn't be surprised if before the banks do that, there is a conversation with the Reserve Bank about help and support, and maybe even buying bad assets and moving them off the bank's balance sheet to make it an easier task, because the last thing that the Reserve Bank would want would be weak banks. After all, Emptor and the Reserve Bank keep saying our banks are remarkably strong, very resilient, have no issues at all. I hope it's true. I have my doubts. Okay. Chris says, do you acknowledge that statistics alone are not empirical evidence of the current economy? Yes, I do. Remember that what I'm doing is looking at data, and I'm putting it into my modeling, and I'm basically forming some views, but I'm also using other sources and other mechanisms too. But I can tell you this, having data is a really good starting point, particularly customer data, particularly household data. I mean, I've been talking for 2 or 3 years about issues in the market and, you know, bad loans and those things. None of that came through in any of the public statistics. None of that came through in the bank reporting seasons. None of it came through in any of it until the Royal Commission started revealing some of it. Now, you know, like it or not, the data that I have is actually very powerful in terms of predicting what's going on. So it may not be perfect, but it's better than a lot of others, I think. Okay. Michael asks, do you think this is going to have a major impact on home prices in the future? Yeah, I think it will. I think I said earlier on, look, it could be a 10-year thing, this, or more. This is not likely to be something which bounce back quickly, I'm afraid. It's going to be a long-term correction. It's going to be a grind down. It's going to have probably a little, you know, a few ups and down movements on the way, but this could well be a 10-year thing. And look, I'm not sure we're ever going to see another boom in property like we had from, let's say, 2000 onwards. That was created by very loose lending, the releasing of the regulatory frameworks around the financial system, financial deregulation, the rise of mortgage brokers, the focus on ever large banking systems. My own view is the banks have got out of hand. We need to actually get them back into their box. And, let me just say here, there is a Senate inquiry at the moment looking at banking separation. I firmly believe that we would do better if we were able to split our banks from the risky side and the meat and potato banks, and effectively put banks to work for Australia and remove some of those speculative activities. If you haven't made a submission to the Senate inquiry, it's worth doing. There'll be a post coming out tomorrow from Robbie with the CC. He and I have been talking about this, and that'll come up soon. I'll be doing a post next week as well, just to underscore some of the principal points that I think it's worth making. We're not trying to tell you what to say, but my view is this is an opportunity to try and shift the conversation and think about getting a banking system that works for Australians. Okay, what else have we got? Michael said, I missed the first part of your question. You'll have to ask the question again, Michael. I don't see what the first part was. I can try and look. Richard says, how do you do all things alone? Yeah, it's a good question. With difficulty and being very organised, I think. And I've got a number of people who I work with, like Joe and John and Edwin and some other people too. So that all helps, but it is quite a challenge. One of the reasons why I mentioned Patreon and PayPal, as I will towards the end of this, is it helps me to not to have to do some of the other stuff that I should be doing, which is the other business that DFA runs, which is providing work for clients, because it's quite tough. But I also am passionate about this. This is a really critical moment for us, whether we're in Australia or New Zealand or elsewhere, right? The banking system and the financial system and the broader economy is on a knife edge at the moment. And what I'm trying to do is to help and inform people to make better decisions. That's from a policy perspective and an individual perspective, because there are lots of issues in the pipeline. And frankly, I don't think the mainstream media is doing a very good job. I feel passionately that there is a role for DFA to be involved in helping to inform, which is why I do what I do. Okay. CD1. I was told house prices double every 7 years. I want some of that action. How should I start on my property portfolio? I have no time to waste. Well, here's the thing. If you look at the long-term trend of house prices over the last 150 years, it's hardly true that they've doubled every 7 years. For the last 20 years or so, 30 years, yes, they have. They've gone up a lot. But that was abnormal. That was because we had the loosening of the banking system, loose credit, all the other things we discussed earlier. That's abnormal. It's unlikely that prices will do that again anytime soon. So we have to think about a new normal, and that basically says that property is more about finding somewhere to live rather than it's seen as an investment asset class. That's just the way it is. When you think about somewhere to live, you worry less about future capital growth. You worry more about, is it where I want to live? Does it have what I need? So I think we need a different way to think about property. And frankly, I'm skeptical of a return anytime soon to another speculative bubble in property. That's just my view. Could be wrong, but we'll see. Okay. What are the effects of mortgage stress and defaults on super, the ATO allowed to draw down? You're right, Duke Overstate. Yes, you're right. So we see a rising number of people tapping into their super for either need for health reasons or need for financial reasons. Now, there are some strict limits about what you can and what you can't do, but it is a rising thing. In fact, the ATO does report statistics on it. And it is, if you like, the last bastion of rich wealth that people may have, even if they've saved half for a few years. But the other thing I'd say is about superannuation. Remember, a lot of superannuation is invested in property. It's invested in the finance sector. And so superannuation savings are in their own way at risk in the current environment too. It's something which people don't recognise. So superannuation is not a safe, secure bet either, particularly if you've invested in property in the superannuation fund directly or indirectly. And one of the things I would say is you should ask your super fund how much is actually in property how much is in the financial sector, and how much of it is in the Australian part of it, because you may be surprised by the answer. Okay, let me just see, where are we? 9:18. All right, so I'm going to take one more question from the here. Kerry asked about property data, which is 3 months old. Yeah, there is issues with the data. I've discussed it a few times, discussed it today already. The fact of the matter is that the data that the ABS uses, which is sort of via CoreLogic, is 30 days plus 9 days at least behind settlements, and we know that settlements can take 48 days or so to get into the system. So when you transfer a property and it's settled, that settlement is recorded as a transaction 2 to 3 months later. So effectively, a lot of the data that people are making decisions on today is 3 months old. That's a big deal, and particularly in a falling market. When prices are continually going up, it's perhaps less of an issue because you can sort of project it forward, but when prices are on the way down, it's a big deal. How do I know? How can I know, and where do I get accurate information? It's tough. As I said earlier on, it really is tough. The other thing to say, of course, on low volumes, low auction volumes, low transaction volumes, you've got a much smaller base of data to actually then form an opinion about what prices are. And as I discussed with Joe Wilkes quite recently, quite often what happens is the official version of what prices are and the true version are not the same. And many people refuse to accept that prices have already dropped. This is a big deal. The other question you had was on regional areas. Yeah, I want to cover regional areas in more detail. And the way I'm going to do this is to say I will pick a few postcodes and I will go down to a postcode level analysis in a few areas. So not on the live stream, but after the live stream, if there's a particular area that you'd like me to analyse, let me know. I know that somebody said Newcastle on the stream tonight. I've done some stuff on Newcastle before. I know people have talked about other areas around the country as well. So I'm going to try and do some deep dives into regional areas. But as I say, the problem is the regional area data is very, very fragmented, and it's quite difficult sometimes to really be able to get good data. Okay, now I'm going to skip over the rest of my questions for tonight because I want to go through to wind up the show now at 9:21, and I'll come back and look at any last questions. Can I just say that let's go back to here. Yeah, I'm just going to go back to my screen. There we go. Yeah, so what I want to do here is just remind you about Patreon. Patreon is a way that allows us to be supported. We've got now 199, well, 200, but somebody dropped off for some reason. 200 patrons, 199 patrons. You get access to additional information early. You get a whole bunch of other data as well. So it gives you another channel to also connect with me. And this is basically an ability to be able to contribute on an ongoing basis. So please consider Patreon. It really is the way that we actually can fund what we do. And frankly, there are costs involved in just doing what we do, as you perhaps imagine. Also, there's PayPal. You can make a one-off donation via PayPal, and it is the simplest way, perhaps, for some people to do that. Some people also said, look, I don't want to use PayPal or Patreon. Drop me a note. There are other ways of actually supporting me as well. People have actually even send money in the mail sometimes, which I really appreciate. The point, though, is we do this partly because we're passionate about it. We do this also because we have the data. We don't do this to make money. Every dollar we get from either of those channels goes back into making more stuff for you. So just to reassure you, this is not a money-making operation. I could think of much cheaper ways, better ways to make more money, frankly, just sell more of my data. But this is about helping to inform the community. Next thing to say, of course, is the DFA blog contains a whole lot of stuff. There is loads of information on the blog. You can also subscribe to get all of our alerts, everything we do up on the blog too. So you might want to have a look at that. Also, for any reason the DFA disappears off YouTube, the blog will continue because I actually have that. I would say we got a denial of service attack a couple of weeks ago on the blog. We solved it, so we're still up. I'll just tell you about some of the top hits. We've got some good posts. A QE discussion, a change in the QE weather. and how it will impact savers. I'm amazed how savers are being taken to the cleaners, and yet we seem just to, roll with it. Our Property Imperative Weekly is done each week. Interesting question is to know whether, in fact, the Property Imperative Weekly is valued. It gets the lower viewings now relative to the rest of the posts that I do. So I'm wondering whether, in fact, I should stop doing the Property Imperative Weekly and focus on individual posts. Tell me what you think. Is it time to stop blaming immigration? That's the one with Joe Wilkes. Joe Wilkes and I collaborate on New Zealand. Joe is great on the ground there. He's done a number of very interesting videos. We're going to do more. New Zealand, of course, is going through a very interesting evolution now in its property sector, and there's a lot of information going to come from that source. What are households thinking now? That's my household surveys. If you want to get really dirty into what people are thinking, that's a really good source. It's time to get real. That's with Tony Lacroutre. Tony's going to come on in a couple of weeks and do another show where we try and start thinking about strategies for dealing with some of the uncertainty. So he can provide advice because he's a financial planner and advisor and investment manager. So I'm going to get him back on. If you've got questions for him, send them through. And finally, of course, I'm still working with John Adams. We did a post on the In the Interest of the People channel called A War on Cash is a War on the People. That's what we talked about: quantitative easing, digital migration of cash, and all of the issues around that. I continue at the moment to broadcast an alert on the DFA channel when John and I do something on In the Interest of the People. I will stop doing that at some point quite soon now, because you have the opportunity to subscribe direct on that channel if you want to see what we're doing there. But that's a little bit of additional information. So just a few that have been quite popular over the last few weeks. And then just to say, going back to my question about, so what can we do? How can we think about this? I find Harry quite interesting to talk to. I don't agree with all his views, but I have arranged with him to do a webinar on Monday the 25th of March at 12 p.m. Sydney time. It's that time because he's actually over in the US. And you can join that session via the link that's there. I'll also put it in the comments below. And during that, we're going to discuss Harry's views with regard to what's going to happen ahead. We're going to discuss Australia and how that plays into it. So Harry and I will be discussing some of those things, but you can also interact as well and potentially be involved in some of those discussions. So I'll be interested to see whether that resonates, whether that's something you'd like to get involved in. And also, if this is sort of useful, in other words, getting people to talk more about what we should be doing, tell me, because perhaps I can get other people to come on and talk about strategies and what to do. Not my role, but I can perhaps help to facilitate it. Okay, so there's the link. As I say, it will be available also in the comments below, and then I'm going to put out an alert via the DFA blog over the next few days, and hope to see you on that webinar on Monday, the 25th of March at 12 p.m. Sydney time. Okay, so I'm just going back to the live stream and just see whether there are any last questions. T-Tail says, I love your Property Imperative Weekly. It's just the length that puts people off. Maybe break it up into 10-minute episodes. Okay, that's interesting. Okay, well, I can make it shorter, I guess. It's just there's so much going on at the moment. I used to do them quite a lot shorter. So that's interesting. Thanks for that. Okay, anything else? Harold says, any reading YouTube channels or experts you recommend, like Peter Schiff? Oh, you've lifted quite a few. Look, I'll be honest with you, Harold, I don't watch a lot of other stuff. I could spend all of my time watching other stuff on YouTube, or I do a bit of reading, but I'm trying to do primary research predominantly. So I use my household surveys, I look at all the other primary data that's there. So I'm probably not the best person to ask, but maybe the thing we should say on the channel here, guys, if there are other people that you think are really helpful in terms of providing perspectives, call them out and then share that information on the YouTube channel. That would be very, very helpful. Okay. Yeah, Peter, I agree. Macro business, work in progress. Okay. Now, given the weakness in your surveys, any idea when we might see unemployment increase? Yes, good question. It's going to be probably 6 to 12 months before we really see it ticking up. I think that we're going to see retail, we're going to see construction, both coming off. We know that there are a lot of people who are not now able to see their next job. They're a tradie and they're coming to the end of their current piece of work and they've got nothing. I'm seeing retail looking very sick, and I'm also seeing the finance sector cutting jobs as well. I think there are going to be significant restructures there and job losses too. So to my mind, it's likely that we're going to see that begin to move up, but it's probably 6 months or so before we really see it starting to move. That's why I think the Reserve Bank will wait until later in the year before they cut. Okay. All right. Well, I think 9:29, I'm pretty much done out, I think. Thank you very much for spending time with me. You may have noticed that the camera did not overheat tonight. I fixed that problem from last time. It was to do with the fact that they made a firmware upgrade but hadn't actually kept the settings the same as previously, so at least we got that going. So I want to say thank you very much for spending time with me, supporting what DFA does, contributing and making the comments that you do. It's really, really appreciated. And, you know, my commitment to you guys is we will continue to put out as much information as we can. We want to keep the quality up as best we can. We'll continue to use our network of contacts, which is growing all the time. Probably get Eddie Hobbs back sometime. I've got other people I'm trying to get on the channel as well. Sometimes it's quite difficult to get them on for various reasons. But there's more exciting things planned. I've got much more to talk about. I've still got the capital market stuff to do. I've still got stuff to do in the regional areas. Time is my enemy, I'm afraid, so I can only do as much as I can do. So thank you very much. Good to see you all, and I'll wish you a good evening. See you next time. Thanks for watching.